The economy should have collapsed by now. Inflation's still eating your paycheck. Until recently, interest rates were at 20-year highs. Major companies are quietly cutting thousands of jobs. And yet the stock market just keeps climbing like nothing's wrong. I'm going to show you exactly why this illusion exists, the three forces nobody's talking about that are about to collide, and how you can position yourself to profit when it all comes down. Look, if you're paying attention to what's really happening right now, things don't add up. You walk into the grocery store and your bill is higher every single week. The average household is spending over $1,000 more per year for the exact same stuff. Gas, rent, insurance, all climbing. Your purchasing power is getting destroyed in real time. But here's where it gets interesting. While your wallet feels lighter, the stock market is near record levels. The S&P 500 is acting like we're in the middle of an economic boom. Corporate earnings reports get published and half these companies are missing targets, yet their stocks barely move. It's like watching someone stack bricks higher and higher on a foundation that's already cracking. This disconnect isn't random. It's actually a pattern that plays out before every major crash. In 2000, everyone thought the internet changed the rules of valuation. In 2007, everyone believed housing prices could only go up. And right now, in 2025, everyone's convinced that AI and whatever the next hype cycle is will keep this party going forever. What they don't want you to know is that there are three specific forces already in motion. Forces that institutions are tracking very carefully while regular investors are completely blind to them. And here's what most people miss. These forces don't move fast. They build slowly, quietly, until one day, they don't. Let me show you what's really happening under the surface. Force number 1, the debt trap. Right now, American households are sitting on record levels of debt. Credit card balances have exploded past $1 trillion. Auto loans, student loans, personal loans, all at multi-decade highs. And here's the part almost nobody talks about. This debt was taken on when interest rates were near zero. But rates aren't near zero anymore. What does that mean? People borrowed 0% dollars but are paying them back with 4% dollars. Every dollar of debt now costs more to service. People who could afford their lifestyle a few years ago are now choosing between paying the credit card bill or buying groceries. Businesses face the exact same squeeze. Companies that gorged themselves on cheap money during the pandemic are now suffocating. Their debt payments have doubled or tripled. And here's where it all starts to click. When businesses can't service their debt, they cut costs. That means layoffs. That means reduced spending. That means the economy starts contracting. You see this playing out right now in the commercial real estate market. Office buildings are sitting empty. Owners can't refinance. Defaults are starting to pile up. But here's what institutions understand that you're never going to hear on the news. Commercial real estate is just the first domino. When those loans default, banks take losses. When banks take losses, they stop lending. When lending stops, the entire economy freezes. Force number 2, the Fed's timing paradox. Now, let's talk about the Federal Reserve, because this is where most people get it completely backwards. Everyone thinks that as soon as the Fed starts cutting interest rates, everything goes back to normal. The stock market rallies, the economy heals, problem solved. But here's the real magic. Every major recession in modern history didn't start while rates were going up. It started after the Fed began cutting. Think about that for a second. The Fed only cuts rates when something is breaking. They don't cut because things are great. They cut because growth is slowing, unemployment is rising, or the financial system is under stress. So when you see headlines celebrating the first rate cut, that's not the all-clear signal. That's the starting gun. And here's the part that should worry you. The Fed doesn't announce failure. They just quietly start cutting and hope you don't notice the system breaking underneath. In 2007, the Fed started cutting rates in September. Lehman Brothers didn't collapse until a year later. In 2001, the Fed started cutting in January. The recession didn't officially hit bottom until late 2002. The lag time between Fed cuts and real economic pain can be 6 months, 12 months, even longer. And here's what people miss about this cycle. The Fed has kept rates high longer than almost anyone expected. Corporate balance sheets are strained, consumer savings are nearly depleted. The Fed finally blinked and started cutting, not because they wanted to, because they had to. Force number 3, the valuation illusion. Here's a signal that many people don't know about. Warren Buffett calls it the single best measure of whether stocks are overpriced or not. It's the market cap to GDP ratio. Basically, it compares the total value of the stock market to the size of the economy that supports it. Right now, that ratio is over 220%. A ratio of 100% has traditionally indicated fair stock market valuations. Think about what that means. Stocks are priced for perfection, as if the economy is growing faster than ever. But the economy isn't growing faster than ever. GDP growth is slowing. The labor market is showing signs of weakness. Tariffs are straining investment and spending. The only thing growing is the price people are willing to pay for stocks. The last few times this ratio hit such extreme levels, we had devastating crashes. In 2000, the tech bubble burst and stocks dropped 50%. In 2020, the pandemic crisis wiped out trillions. And each time, the pattern was identical. Extreme valuations, widespread optimism, and everyone saying this time is different. But here's the part hiding in plain sight. Extreme valuations don't crash on their own. They need a push. That's where forces 1 and 2 come in. When debt stress combines with Fed policy timing, that's when overvalued markets finally break. So here's where we are right now. We're in phase 1. The illusion. Markets are high, confidence is still strong, and most people think everything's fine. The warning signs are flashing, but they're easy to ignore when your portfolio keeps going up. Phase 2 is the recognition. That's when the first cracks appear. Maybe it's a major bank reporting losses, maybe it's unemployment numbers that shock everyone, maybe it's the Fed cutting rates faster than expected. Whatever the trigger, this is when investors start to realize something's wrong. Phase 3 is the cascade. This is where panic takes over. Stocks drop 20%, then 30%, then 40%. Real estate prices finally break. Crypto gets crushed. The headlines scream collapse. Your friends tell you to sell everything. And here's what institutions understand. This is when wealth transfers from the terrified to the prepared. Crashes don't destroy wealth. They transfer it. And the beautiful part most investors never see? The biggest opportunities aren't visible until after everyone else panics. We're in phase 1 right now, approaching phase 2. You can feel it. The data is there. The 3 forces are building pressure. But you still have time. Here's what you need to do right now, today, before phase 2 hits. First, build your cash position. Not all of it, but enough that when everyone else is selling in panic, you have ammunition to buy. Warren Buffett's company is sitting on nearly 50% cash right now. He knows something. Second, make your list. Write down the companies, the sectors, the assets you want to own long-term, quality businesses with low debt, real profits, and products people actually need. When the crash comes, even the best companies get dragged down. That's your opportunity. Third, master your psychology now. Because when markets fall, your brain will scream at you to panic. Every instinct will tell you to sell. The people who get rich during crashes are the ones who train themselves to do the opposite. They feel the fear, but they don't act on it. The math doesn't care about hope. These 3 forces are already in motion. Debt loads can't be unwound overnight. The Fed's policy lag is baked in. Valuations don't stay extreme forever. And when they converge, probably sometime in 2026, you'll have 2 choices. You can panic like everyone else, sell at the bottom, join the crowd losing their wealth, or you can see it for what it really is, the biggest clearance sale on quality assets you'll see in your lifetime. Some quick examples. During the 2008 crisis, Fifth Third Bank, one of the largest banks in America, bottomed at $1.39 in 2009. 5 years later, it was back to $24. If you bought $10,000 of Fifth Third near the bottom, it would have been worth around $170,000 5 years later and around $240,000 in another 4 years. During the dot-com crash, Amazon lost 90% of its value. $10,000 of Amazon, bought near its 2001 low, would be worth over $1.5 million today. That's not a misprint. Every crash in history has created more millionaires than any bull market ever did. 2008 made fortunes for those who bought real estate and stocks at the bottom. 2020 rewarded the people who had courage during the COVID panic. And 2026 will be no different. The question is, will you be ready? Because while everyone else is crying about losses, you'll be quietly building your fortune. That's how you use the 2026 market crash to get rich, not through luck, through preparation, through understanding the forces others ignore. Do one thing today to get ready. In the next hour, I want you to write down your cash target, start your watch list, and decide how you'll react when the first 20% drop hits. What do you think? Let me know in the comments. And smash that subscribe button, because when phase 2 hits, you'll want to know exactly what to do. We publish fresh content several times a week to help you understand the economy and protect and grow your wealth. And keep the momentum going. Watch Why the Stock Market Hasn't Crashed Yet, What They Don't Want You to Know. It's on the screen. And none of this is personal financial advice. This is education so you can build your own plan. If you want to get your financial house in order, I've put some links in the description that may help. Check it out. Thanks for watching. See you on the next one.